Here in this video, we will share a lot of new information that I think you need to know as equity investors. We will discuss the upcoming week ahead and a big catalyst coming this Friday with Fed Jerome Powell. But really, the most important part is what's coming next for markets. After we've seen a 10% top to bottom correction, we've almost retraced that entire correction. Are we due for another drop here, or could we be in for new all-time highs? And how is the leadership going to evolve in our markets? Will we continue to see big tech and semiconductors lead our markets, or should we expect a slower, steady broadening out of our markets? First up, even though it's Saturday, there's no shortage of Wall Street notes that are coming out, which is pretty unusual. Apollo says, quote, retail sales are strong, jobless claims are falling, restaurant bookings are strong, air travel is strong, hotel occupancy rates are high, bank credit growth it is accelerating, bankruptcy filings are trending lower, credit card spending is solid, and Broadway show attendance and box office grosses are strong. There are no signs of a recession in the incoming data. Besides the unemployment rate and the what could be as much as a 602,000 to 1 million downward jobs revision for 2024. But unfortunately, Wall Street doesn't care about that. This is for the number of job creation in 2024. And we really only care about the first number that comes out. Goldman Sachs decreases their 12-month recession probability to 20% after raising it to 25% after the July jobs report. They say, quote, the data released since August 2nd, including retail sales and jobless claims this week, shows no sign of recession. If the August jobs report released on September 6th looks reasonably good, we would probably turn our recession probability to 15%. And that's kind of the problem with Wall Street. They take one or two pieces of data and extrapolate that into a call for recession or no recession. If we get a really bad jobs report coming on September 6th, then Goldman Sachs is going to raise their estimate to like a 40% chance for recession, just off of one data point. And that's why the biggest advantage you have in markets as a retail investor is just to buy and hold. It is also being reported that hedge funds turn net long on the yen for the first time since 2021, which is a pretty good sign this yen carryover trade debacle deleveraging that happened over the past couple of weeks is all but over with. Fed Goolsbee also said after markets closed on Friday, quote, I have concerns that we set this level of interest rates more than a year ago, and inflation and the labor market are cooling faster than expected. I think we should take a step back and think about that. And it's almost like Fed Goolsbee over the past 2 days with his very bullish commentary or dovish commentary is setting the stage for Fed Jerome Powell's Jackson Hole speech this upcoming Friday on August 23rd. Fed Jerome Powell will speak at 10 o'clock in the morning, and all eyes are going to be on Jerome Powell because let's face it, next week we don't have much as far as catalyst. We don't have anything for Monday, Tuesday, Wednesday, a couple Fed speakers here and there, but that's pretty much it. On Thursday, you do have the Chicago Fed National Activity Index, expecting that to be a little bit worse than last month. Initial jobless claims, expecting those to fall again from 227,000 to 225,000. Continuing jobless claims expected to actually go up from last week, about 20,000 or so. 4-week average for initial jobless claims, S&P Global Composite PMIs for August, manufacturing PMIs, and services PMIs for August will be coming out at 9:45 in the morning. That will likely be one of the bigger catalysts for Thursday morning alongside initial jobless claims. Existing home sales, as well as existing home sales month over month, will also come out at 10 o'clock in the morning. And Kansas Fed Composite Index, as well as Kansas Fed Manufacturing Index. But that's it. That's really all the catalysts for this week. And then you have Fed Jerome Powell, and the Fed is likely going to be very dovish. I don't know if Fed Jerome Powell is going to go as far as to say the fight on inflation is over with, but it's possible. At the bare minimum, we are going to get a Fed Jerome Powell that is pretty dang committed to cutting September 18th. Yes, we do have almost 5 weeks left until September 18th. Fed rate decision. But given what's happened in the last couple of weeks with the data that we've started to see, it would really take some strong economic data, which, by the way, would be good for markets, or some really hot inflation data coming out around September 11th to not have the Fed cut rates. I think that would be a real shocker to markets if Powell does not confirm a September rate cut. Just given how bullish Fed Jerome Powell was on the last press conference, I imagine we're going to get something that's even more bullish at Jackson Hole. Now, as I have said many times here on this channel, if we get 25 basis points of a cut September 18th, that's good for markets. If we get 50 basis points, that's not good for markets, because the markets don't want to see the Fed behind the curve forced to cut rates aggressively because of economic pain. Now, take a listen to this clip from CNBC. It's about 5 minutes long that says a Fed rate cut will be the next big catalyst for new highs in markets, according to Courtney Garcia.
Advisor with Payne Capital Management. As you see, both are here at Post 9. It's nice to have both of you back. Court, so what do you make of this market? I think its hallmark will go down to be, the bull market anyway, one of resiliency. I mean, at every turn, you throw almost anything at this market, and it shrugs it off and continues to do what it's doing.
Yeah, and I think the downturn that we had about 2 weeks ago, there was fears that was because we were going into recession after you got a bad unemployment number. But the fact that you're seeing the markets really shrug that off is because you're getting a lot of good data. We got CPI coming out, PPI coming out, you got retail sales. The big picture is that the consumer is still holding in there. Inflation is still coming down. And a lot of those recession fears are likely overblown. And that downturn we had was more likely due to that yen carry trade than us going into recession, which would be a worse thing for the markets.
Yeah.
And that, I think, is ultimately going to put the market's on a positive backdrop.
All right. Kevin, you see it the same way?
I'm not so sure that, when you look at the sell-off, the sector action wasn't telling me a lot that the market was expecting or fearing a recession. When you look at the sectors that were underperforming the broad market, the S&P, in that period, the entire drawdown from mid-July to early August, it was just tech and consumer discretionary. Both of those driven by a lot of mega cap weakness, which actually preceded the peak in the market and that kind of waterfall move down. Yes, you did see some weakness in cyclicals, but there wasn't this message from financials or industrials or materials that you were going into this recession. So I understand the fears around, why the jobs report came in, worse than expected, and the uptick in the unemployment rate, why that could send some fears into the market. But I'm not so sure that the message has been one of recession.
Last Monday specifically, there was a panic attack that we not only were having a positioning unwind, but that we were, in fact, maybe closer to a recession than we thought, because the employment report the prior Friday sort of set everybody off. And then we opened Monday and you had that confluence of events, not to mention Buffett selling half of his Apple stake. And we're like, okay, what's going on here?
I think even with that, though, it was amazing to me to look at some of the reactions to the jobs report itself as if all of these problems just started to crop up out of nowhere. We've known that the unemployment rate has been drifting higher, payroll growth has been softening, there have been massive cuts to the work week, cyclical hiring has been slowing, the list sort of goes on. That's been the trend over time. So I don't think there was any one particular thing in the jobs report, excluding the uptick in the unemployment rate, but even with that, I think that there's not a lot of supplemental labor data that are yet confirming that. You can look at the trend in initial jobless claims. That's starting to roll back over, not confirming the uptick you've seen in the unemployment rate. You can look at the employment to population ratio on a prime age basis. That's rising. Doesn't happen when you go into recession. So there's enough there still in this unique cycle, which I think we have to keep in mind from a labor supply perspective, that is skewing a little bit different this time. I don't want to completely ignore the unemployment rate risk, but I think it's an important, sort of nuanced look at the labor market for this particular cycle.
When I asked the question at the top of the show, are we going towards new highs again? And are we going to be able to eclipse? We're only 2 to 2.5%.
Yeah, I think
away from that.
Yeah, especially when you look at what's been leading us off of this low. It's been tech and consumer discretionary, which is not surprising given they were sort of at the epicenter of that selling pressure. But if you get more of these clusters of days where advancers relative to decliners, are really strong, kind of in that 6 to 7, 6 to 7 advancers relative to decliners range, I think it's plausible to see that. The key, in my opinion, when you get to that next all-time high, whether it's a week from now, a month from now, is what the breadth picture looks like under the surface. And so far this year, I think one of the strongest aspects of this market has been the fact that when you look at the percentage of companies in the S&P above their 200-day moving average, you've kind of hung in at the 60 to 80% range, 60 as a solid floor, 80%, 85% as a ceiling. And I think as long as you can keep that, you probably keep everything intact, especially because you now have the added benefit of inflation not only rolling over again, but inflation surprises being much more tame and much more muted. That tends to be a really positive backdrop for the equity market. So,
Corey, you would agree then with J.P. Morgan and sounds like Kevin Gordon, the bullish narrative remains intact. That was the headline of one of their notes today, and they do talk about rate cuts being a welcome sign. Some people suggest, sell the first rate cut. And I think they're implying that, well, they're cutting because the economy is softening, whereas others would counter with, no, they're cutting because they're just too restrictive and things are working in their favor, so they can and should.
Yeah, and I would agree with the latter there. I think you're really seeing the idea that rates are coming down is more so because inflation's coming down as opposed to the economy being in a bad position. They need to prop it up. That would change the picture if that happens. That's, again, I think what people started to question about 2 weeks ago, but we really haven't seen that be the case. And I think, too, as you're looking forward here, if the Fed does, in fact, cut interest rates, there is still record levels of cash on hand right now. I think we're at like 6.2 trillion or something in that range. And if rates come down, you're not going to be getting that 5% interest rates any longer. And you're going to start to see some of that money come in. And I know we've talked about this for a while now, because the question is when that's going to happen. But that really will probably be the next big catalyst to see those markets go to new highs.
So let me paraphrase that. JP Morgan says whether or not we get a 25 or 50 basis point rate cut, it should be seen as a welcomed sign by the markets. I don't think 50 basis points would be seen as good. There's a way the Fed could spin it potentially to be seen as good. If the Fed was super dovish, they just say, hey, we want to just get a little bit of a head start here on getting back to something more neutral. We're going to start with a bigger cut, but we see things as just fine. We just think inflation's gone. And if Fed Jerome Powell this Friday confirms that they think inflation is gone, that they essentially declare victory on inflation, perhaps I could see a path to the Fed engineering a 50 basis point cut in September, and that actually be good for markets. Odds are, according to the markets, over a 75% chance that we get a 25 basis point rate cut. And I think that will be seen as very positive for equities, given the recent backdrop we have seen in economic data. Again, we have 5 weeks until September 18th. As long as inflation continues to come in low, as long as the economic data continues to come in good, I do think the first Fed cut will be seen as a positive. Now, what Courtney Garcia is saying here is, well, there's $6 trillion or more of cash on the sidelines sitting in money market funds. You could look at Warren Buffett's portfolio and his almost $300 billion in cash alone. That's a decent chunk. That's like 5% of that $6 trillion. And say some of that money might start to get deployed into markets as the Fed starts to lower rates, especially if the Fed does cut rates at 50 basis points at the first meeting here in September rather than 25 basis points. So I think there is a very logical argument to say that could spark new all-time highs in markets. Time will tell whether or not markets hold up at these levels. What will determine that is obviously, number one, corporate earnings. Corporate earnings have a high bar to beat in 2025. We know that's for sure. If we beat that, great. If we come in a little bit low, I don't think that matters either, as long as expectations stay where they are. The most important thing in the immediate term is the potential of a recession, is the economic data. If the economic data gets worse, markets are going to get worse. If it gets better, markets are going to get better. And this is a much different environment than, let's say, what you've seen in 2022, where bad economic data was seen as good news and good economic data was seen as bad news, because at that point we were really just fighting the Fed. Now, bad news is bad news, good news is good news. And I think it's been that way for a period now. And I think that's just even more exacerbated. Okay? Bad news is bad. Really bad news is really bad news. Good news is good news, and really good news is really good news for equity markets. As far as CNN's Fear and Greed Index, you are sitting at 35 here on this Saturday afternoon. I would say it's sunny out, but it's quite rainy out, in fact. So you're about in the middle of fear. we're about 2% off all-time highs. So in theory, you could see markets rally aggressively to the upside and maybe be in neutral, maybe be in a little bit of greed, but not even close to something that would be too overextended. Something that I like to look at all of the time as well is the percent of stocks trading above their 50-day moving average. You're at 56.63%. So the 50-day moving average is more short-term in nature. I know that individual on that clip that we just looked at was talking about the 200-day moving average. I like to look at the 50-day moving average a little bit more to give you a sense of breadth, right? Because if you're above the 50-day moving average, that means you've been trending upwards at least for a period in time, okay? 56.5%, let's call it, percent of stocks currently trading above their 50-day moving average. Almost half of our markets. It's not great by any means, but it's not terrible either. Once you get to like 85, 90% of stocks trading above their 50-day moving average, that's usually when you're getting pretty overextended, okay? Now, recently, ever since December of 2023, we have not even gotten close to that. The highest level we hit was 75%, and one would say that's a really bullish market, but we only briefly hit that with the small cap rally, the rotation rally we've seen in markets just a couple of weeks ago. But I think if we really do see the data start to point towards a soft landing, if we do see the Fed that starts to cut rates and signals that this Friday, at least 25 basis points, they could kind of, guide us for 50 basis points, although I think that's a little bit harder to make the bullish argument for, then I could definitely see a larger kind of rebound rally here. But then again, at that point, you're really betting on the economic data coming in good. And if it comes in bad, then markets are going to fall. But basically what I'm trying to say here is there is room for continued upside moves in our markets if that data does come in good. Here in this week's earnings lineup as well, we do have quite a few important companies. You have Palo Alto, Monday and after hours. You have Lowe's, Tuesday pre-market. Toll Brothers, Tuesday and after hours. Wednesday pre-market. Target, Macy's, TJX. A lot of your retailers reporting earnings this week. Although I think Walmart was the most important, these other guys can still be important as well. Wednesday and after hours, Snowflake, Zoom, Wolfspeed, Synopsys, and others. Thursday pre-market, Baidu, Peloton, Advanced Auto Parts, BJ's, Weibo.com. Thursday and after hours, you have Kava, Workday, Bill.com, Intuit, Ross, Red Robin. And then Friday, you have just a couple of companies that you've probably never heard about. So you still have some important earnings here that will still tell us more about the consumer. And you really want to hear good things about the consumer at this point. Like if Target, Lowe's, Macy's, TJX, if these companies do beat on earnings and have positive things to say about the consumer, I do think that in and of itself is a catalyst for this upcoming week. With that said, the bottom line is I am expecting a lot of volatility. I don't think this is going to be a situation where all of the economic data comes in good or all of the economic data comes in bad. Now, I do think eventually the data will start to turn more to the bad side. The question is, when does that happen? What happens in markets from now until then? Let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. Most importantly, enjoy your weekends, and I will see you in the next one.